Welcome back to the Deep Dive. Today, we're doing something a little different. We are zooming way, way out, so far out that the day-to-day headlines, the market noise, it all just kind of vanishes.
We're going macro, very macro.
Exactly. We are plunging into the biggest patterns in history. We're talking about the mechanics, the actual gears behind the rise and fall of empires, their currencies, and how debt really acts as the ultimate catalyst for both creation and, well, destruction.
It's the accelerant, for sure.
Our whole mission today is to unpack this huge, multi-century study. It's developed a kind of universal template, an archetype they call it, that seems to govern these massive civilization-shaping shifts.
And these are cycles that are so long, they just dwarf any single human lifetime. You can't see them in your own experience.
Right, but they're so consistent that if you understand the pattern, you can start to anticipate what's coming next, sometimes decades ahead of time. And the core belief behind all this work is, it's really fascinating.
It is.
The author basically argues that the times right ahead of us are going to feel completely radically different from anything we've experienced, in our modern lives.
Especially if you grew up after, say, 1980.
Exactly. But, and this is the key, historically, they're going to be fundamentally similar to many, many other periods of great change. It's like, if you know the script, you're much less likely to be surprised by the next act.
That's the whole point, to find that script. And this study was really prompted by seeing a dangerous combination of three very specific, very unusual developments.
Okay.
Unusual for our lifetimes, but not for history. And whenever these three things line up at the same time, history suggests a major world order transition is pretty much inevitable.
What's the first one?
The first is hitting our financial limits. We're just navigating these incredibly high levels of debt everywhere, private sector, public sector, you name it.
And interest rates are on the floor.
On the floor. Rock bottom. Sometimes even negative if you account for inflation. And what that means practically is that central banks have lost their main tool, their power to just, cut rates to stimulate the economy. It's gone.
There's no stimulant in the bottle left, as the source puts it.
That's the perfect phrase. It's empty. Which means the response to the next crisis, whenever it comes, has to be something completely different, something unorthodox.
Okay, so that's a fragile financial system. What's the second factor?
Internal conflict. And this is what really magnifies the financial stress. It's not just that the finances are stretched, it's that everything is so unevenly distributed.
The wealth gap.
The wealth gap, yeah, but also political polarization, ideological divides. It's happening in most major countries, but especially in the U.S. History shows that when the economic pie stops growing, or at least stops growing quickly,
The fight over the slices gets ugly.
it gets very ugly. It stops being about how to make more and becomes all about how to divide what's left. And that's the breeding ground for populism, both on the left and the right. It challenges the whole system.
And the third piece of this puzzle.
The external challenge. So while all this is happening internally, you have the existing world power, the United States, which is seen as overextended, financially strained.
And at the same time, you have a rising power.
China, exactly. China is rapidly gaining ground and challenging the U.S. on almost every front. Technology, trade, economic output, you name it. And that dynamic, the established leader being challenged by the rising star, that is the classic textbook precursor to major global conflict.
Or at least a massive geopolitical reshuffling.
A restructuring negotiated under incredible stress.
So it's this perfect triple threat. Your finances are fragile, your society is tearing itself apart, and you got a powerful rival knocking at the door. The source material calls these periods cleansing storms.
It's a great analogy. They're not just random market wiggles. They are these 10 to 20-year transition phases that happen between the really big 50 to 100-year cycles.
So what are they? What are they cleansing exactly?
They're cleansing the excesses, getting rid of unsustainable levels of debt, purging all the financial and, frankly, moral rot that builds up during the good times. It's painful, it's destructive in the short term, but it resets the foundation for the next big cycle.
And it often changes who's on top of that new global order.
Often.
That
Yeah.
makes the purpose of this whole deep dive so clear. It's about getting past just forecasting and really understanding the mechanisms. So how do you even begin to build a universal template for something as chaotic as human history?
You have to be methodical. The approach was almost forensic, treating history like this massive collection of case studies.
So you're looking at the Dutch and British empires.
The Dutch, the British, the U.S. in the 1930s, even going back to Chinese dynasties, the Ming, the Tang. The goal is to study dozens of these cases to pull out the the timeless and universal principles. It's not about academic knowledge. It's about creating a practical map for navigating the future.
You know, what's fascinating here is that this whole thing was apparently sparked by a personal mistake the author made.
That's right. He said his biggest career mistakes came from missing these huge market moves that hadn't happened in his lifetime, but had happened many times before in history.
The prime example was the 1971 dollar devaluation, the Nixon shock.
Exactly. He was on the floor of the New York Stock Exchange at the time, and when Nixon announced he was breaking the dollar's link to gold, everyone, I mean, he and all his colleagues, they braced for a complete crash.
Pandemonium, panic selling.
They expected the world to end, but the opposite happened.
The market jumped.
It soared. It was this huge counterintuitive shock. And he realized in that moment that he just didn't understand the script. He didn't have the long-term historical context to know that currency devaluations often spark stock rallies.
Why is that, though? Why would the market rally when your currency is being devalued?
Because it flushes the system with liquidity. The government is essentially printing money. That money has to go somewhere, and it flows into financial assets. Plus, it makes everything look cheaper relative to the new, weaker currency. That knowledge gap was so profound for him that it basically set him on this path to dig through centuries of data to avoid getting blindsided again by another one of those.
One of those once-in-a-generation events. It really just drives home the power of perspective, doesn't it?
Yeah.
Shifting from your own 50-year frame of reference to the thousands of years of recorded history.
It changes everything.
The visual analogy they use is perfect for this. The idea that the pattern of history is like an upward-pointing corkscrew.
That image just captures the two forces at play perfectly. You have the overall trend, the straight line going up through the middle of the corkscrew. That's humanity getting better over time.
Learning, productivity, technology.
Right. Knowledge, once you gain it, is rarely lost, so the default direction is always up. Better living standards over the long, long haul.
But we don't live on that straight line. We live on the loops of the corkscrew, the spirals, the ups, and the dramatic downs.
That's the turbulence. Those are the cycles, especially the big debt cycles that drive these violent swings around that upward trend. You know, prosperity leads to excess, excess leads to debt, debt leads to a crisis, the crisis forces a painful reset.
And then the whole thing starts over again, but from a slightly higher point on that line.
Exactly, a higher baseline.
And most of us, living our lives, are really like the ants described in the source. We only see these tiny little pieces of what's happening. A recession here, an election there. We can't see the whole chart.
The scale is so important to get your head around. I mean, think about the period from 1930 to 1945, the Great Depression and World War II.
To the people living it, it must have felt like the end of the world.
A total collapse of civilization, and it was a massive trauma. But if you zoom out and look at the data, the entire U.S. economy, in real terms, only fell by about 10% from its peak to its lowest point.
Only 10%. That seems
Impossible. It's staggering, but it's true. Global GDP per capita fell by about 12%. The world was put on hold, and it was devastating for millions. But the underlying knowledge base, the technology, it was all still there, ready for the next phase.
So what felt like an apocalypse was, in the grand scheme of things, a massive stress test.
A stress test that, after all that pain and restructuring, led to a completely new global structure. Bretton Woods, the Marshall Plan, the UN, and then the next 50 years of explosive growth. It reset the system.
Okay, so now that we get the method looking for these timeless patterns, let's get into the template itself. This is what the source calls the big cycle of empire. These cycles are, what, roughly 250 years long?
Yeah, 250 years, give or take 150. It's not precise, but it's a powerful framework.
So what governs the rise and fall? What are the moving parts?
The study boils it down to a single composite measure of a country's wealth and power. It's not just GDP. It's an average of 8 mutually reinforcing indexes of strength. And they don't just tell you how strong an empire is, they explain the sequence of why it gets strong and then, inevitably, why it decays.
We have to nail down these 8 pillars. So the 8 measures of strength are, number 1 is education. Then you have competitiveness, technology, economic output, share of world trade.
Military strength,
financial center strength, and then last, reserve currency status.
And the order is absolutely critical. They don't all rise and fall together. Some are leading indicators, and some, like the currency, are massive lagging indicators. The whole cycle moves through 3 phases based on which of these are peaking.
Let's start with the first phase then, the ascent phase, the rise. It seems a bit strange that education is the starting point. You'd think it would be military power or resources.
But it's the real engine of everything that follows. And the study is very clear. This isn't just about high test scores. It's education that builds strong character, a powerful work ethic, civility, low corruption.
Things reinforced by family and culture.
Exactly. When you have that foundation, you get a society with high trust, an openness to new ideas, a meritocracy. And that kind of system is just incredibly efficient at turning ideas into productive output.
So good character leads to good ideas, which is the next pillar. Innovation and technology.
Right. A culture that's willing to work hard and take risks is going to innovate. That innovation drives competitiveness and productivity, which then leads to higher economic output. It creates this powerful, virtuous cycle.
And that wealth then translates into global power, first through trade.
First through trade, Pillar 5. As your share of world trade grows, you have to build a strong military, Pillar 6, to protect those shipping lanes. Think of the British Royal Navy protecting the trade routes from India. You need muscle to protect the money.
And once you have the money and the muscle, the financial system follows.
Then you get the emergence of the world's great financial centers. Amsterdam, then London, now New York. They become the place where the world's capital is managed. And that strength, finally, leads to the 8th and final pillar. Your currency becomes the world's reserve currency.
And that's what you call the long lagging strength. Why is it always the last one to peak?
Because it's all about habit and infrastructure. It takes decades, sometimes a century, for the entire world's financial plumbing, how you invoice for oil, how you settle international debts, to shift to one dominant currency. Once that system is built around the dollar, for instance, it's just easier for everyone to keep using it.
Even after the country that issues, it starts to weaken.
Exactly. The habit lasts longer than the fundamentals that created it. And that lag is crucial, because it allows the empire to enjoy its greatest privilege just as its internal strength begins to rot. Which brings us to phase 2.
The COP phase, sowing the seeds of decline. This is where success itself becomes the problem.
It's almost tragic how predictable it is. First, you lose your competitiveness. All that prosperity makes your workers expensive. Why work 60 hours a week when you're already rich? At the same time, your rivals are busy copying everything you did to get rich. It's always cheaper to copy than to invent.
And the culture changes too.
Deeply. The focus shifts from production to consumption, from saving to spending, from hard work to leisure and luxury. The battle-hardened character of the generations that built the empire starts to fade. The kids who inherit the fortune rarely have the same grit as the ones who made it.
Now, the sources highlighted this direct link between success and the financial downfall. And this is where it gets really interesting, this idea of the exorbitant privilege. Why is having the world's reserve currency actually a trap?
Because it's like having a global credit card with no limit. The whole world needs your currency dollars to trade and to hold in their reserves, so they are forced to buy your debt. This means the U.S. can borrow far, far more money than any other country could ever dream of.
It lets you spend way beyond your means.
Immensely. Think about the 1960s. The U.S. was funding the Vietnam War and massive new social programs at home at the same time. The guns and butter policy, no other country could do that. But that short-term boost just hollows out your finances over the long run. You get addicted to borrowing instead of investing productively.
It's a trap. And the study pointed to a really specific kind of chilling sign that this reversal is happening.
Yeah, that's when the richest country in the world starts getting into debt by borrowing from the poorest.
That happened in the 1980s, right? The U.S. borrowing from China.
Exactly. Back then, U.S. per capita income was something like 40 times higher than China's. Yet the U.S. was borrowing from them. It showed that the dollar's reserve status, that lagging indicator, was still strong, but the underlying economic fundamentals, the savings and investment habits, were already starting to erode badly.
And all that success, all that money flowing in, it also creates these huge wealth gaps at home.
Absolutely. Those with financial assets, they benefit disproportionately, and then the wealthy and the political elite often become, well, mutually supportive. They create a system that protects the status quo, which just makes the inequality worse and worse until the majority of people feel the system is rigged.
And that's the prelude to the final act, the decline phase, the fall. This is where everything starts to spin out of control.
The decline is usually marked by a sudden acceleration. You're already saddled with historic debts, the central bank is out of ammo, and then some kind of shock hits. A pandemic, a banking crisis, a war, and that triggers a severe debt and economic crisis.
And at the same time, because of the wealth gaps, politics gets extreme.
You get populism of the left and the right. both pointing fingers, becoming nationalistic, protectionist. The political chaos scares away capital.
The rich start moving their money out.
Capital flight, yes. The money starts looking for safety, it goes into hard assets, gold, or it just leaves the country entirely. And as the money leaves, tax revenues fall, which makes the economic problems worse, which makes the social tensions worse.
It's a vicious cycle, a downward spiral.
It's a devastating, self-reinforcing, hollowing out process.
And what's the government's typical response when the money starts fleeing?
Control. When things get desperate, they try to lock the money down. They outlaw moving into gold or foreign currencies. They impose strict capital controls. But that just creates more panic and drives more people to break the rules, leading to even more internal conflict. People start to crave a strong, autocratic leader who promises to restore order.
It's a stark template, and the source material connects it directly to today, noting that the U.S. is about 75 years into this cycle, starting from the 1945 New World Order.
Right. And 75 years is classically near the end of a long-term debt cycle. The system is mature, it's rigid, and it's ripe for the kind of restructuring the template described.
Which is why understanding the mechanics of the money itself is so crucial. The argument is, if you don't get the money, credit and debt cycle, you can't understand any of this.
It's the engine of the whole process. Let's just simplify it. Every person, every company, every government has the same basic financial reality. Income has to cover your expenses or you go into debt.
And if your income fails, you either have to sell your assets or default.
Right. Debt is senior. It always gets paid first. Debt eats equity. But there's one massive exception to that rule.
The government with the reserve currency.
Exactly. They can suspend reality for a while. They can literally create money and credit out of thin air to fill any gap. And when a debt crisis hits, they have three terrible options. Brutal austerity, mass defaults, or
the easy way out.
The politically easy way out. Print the money, devalue the currency. The central bank can just create it to pay the bills.
And it feels good at first. Asset prices go up, your stock portfolio looks great, people feel richer, even as their actual purchasing power is being destroyed by inflation.
It's a stealth tax. To really grasp how the system breaks, we have to look at the three types of monetary systems that have cycled through history.
Okay, so type 1 is hard money.
Gold and silver coins. It has intrinsic value. This system gives you maximum credibility because gold is gold everywhere, but it gives you minimum credit. Every transaction has to be settled with physical metal. It's what people use when trust is low, like during a war.
Then as the economy grows, you get type 2, claims on hard money.
Right. Carrying around chests of gold is inconvenient, so banks issue paper notes that are claims on the gold in their vaults. This is what the Bretton Woods system was. It allows credit to boom because banks can lend out way more claims than they have actual gold.
Fractional reserve banking.
Exactly. It's incredibly profitable for everyone until people get nervous and you risk a run on the bank with everyone trying to redeem their paper for gold at the same time.
And that brings us to where we are today. Type 3, fiat money.
In a fiat system, there is no link to hard money at all. The government can print freely. This gives you maximum credit and flexibility in the short term, but it gives you minimum credibility over the long term. The risk is no longer a bank run. The risk is that you create so much money in debt that the money itself becomes worthless.
And the historical record on this is just, it's terrifyingly clear. The study shows that since the beginning of time, every single currency has either been destroyed or massively devalued.
Every single one. And it's almost always in response to a debt crisis where printing money was the most politically palatable solution. It's the path of least resistance.
So this raises a really important question. If history is so clear on this, why do most people, even smart investors, worry more about a stock market crash than they do about their currency becoming worthless?
It's the illusion of wealth. When the government prints a ton of money, it has to go somewhere. It flows into stocks, real estate, bonds, and it pushes up their prices in dollar terms. So you look at your account statement and you see bigger numbers and you feel richer.
But the measuring stick itself, the dollar is shrinking.
Precisely. You're mistaking a rise in price for a rise in actual wealth or purchasing power. The problem with the fiat system is that the supply of money is infinite, but the supply of real goods and services is not. When the government prints money to plug huge holes in the economy, they cheapen the money, and that's a tax on everyone who holds that money or holds debt denominated in it.
It's a stealth default, a quiet wealth transfer from savers to debtors.
That's exactly what it is.
Okay, Let's look at how this has played out in the modern era. Let's talk about the currency catastrophe. The sources show these big devaluations are always tied to financing wars or cleaning up debt busts.
They happen in episodes. The volatility isn't smooth. A great early example is the U.S. Civil War. Both the North and the South needed vast sums of money to fight the war.
More than they could raise through taxes.
Far more. So in the 1860s, the U.S. government just suspended gold convertibility and started printing paper money greenbacks to pay for soldiers and cannons. It was a straight-up monetization of war debt. It caused a huge immediate spike in prices.
But that was nothing compared to what happened in Germany after World War I.
No, the hyperinflation in the Weimar Republic from 1920 to 1923 was the complete, total extinction of a currency. It was the direct result of the insane war debts and reparations Germany was forced to pay. They had no other choice but to print. It got so bad, people were using wheelbarrows of cash to buy a loaf of bread.
Just worthless paper.
Worthless. But even the winners, like Britain and France, had to significantly devalue their currencies to deal with their own war debts.
Then the next big one was the 1930s, the Great Depression.
The debt bubble of the 20s popped, leading to a global debt crisis, and that sparked what they called competitive devaluations. Every country was trying to cheapen its currency to export its economic problems to its neighbors. Roosevelt devaluing the dollar against gold in 1933 was part of that scramble.
And then World War II just put that whole process on steroids.
Unprecedented levels of war debt requiring even more printing. By the end of the war, the currencies of the losers, Germany, Japan, Italy, were completely wiped out. A total reset, which provided a clean slate for the winners.
Which sets the stage perfectly for the modern U.S. dollar's journey. There are three big policy shifts that got us to where we are today.
The first one is 1945, the New World Order. This is the Bretton Woods Conference. The dollar is officially made the world's reserve currency. It's a Type 2 system paper dollars linked to gold at a fixed price of $35 an ounce.
And at the beginning, the U.S. had all the credibility in the world.
All of it. The U.S. held 2/3 of the world's gold and was producing half of the world's economic output. The system started with nearly 100% gold backing. Maximum credibility.
So how did that system unravel? How do we get from total trust to the Nixon shock?
It was undermined by political choices, the guns and butter spending, funding the Vietnam War and the Great Society at the same time without raising taxes to pay for it. The U.S. government was spending way more than it took in, creating all these new dollar-denominated debts.
And the Fed was just printing the paper claims to cover it.
They were printing more and more paper claims on a pile of gold that was staying the same size, or even shrinking as other countries, like France, started getting nervous and redeeming their paper for physical gold. The ratio of paper to gold got dangerously high. A default was inevitable.
Which brings us to shift number 2, 1971, the Nixon shock.
August 15th, 1971. President Nixon goes on TV and unilaterally defaults on the gold promise. He severs the link, and in that one moment, the entire world shifts to a pure fiat Type 3 system. The only thing backing the dollar from that point forward was the full faith and credit of the United States.
Which, as we know from the story earlier, did not cause a market crash, but a rally. But that unconstrained printing led directly to the chaos of the 1970s.
Total chaos. The global monetary anchor was just gone. Inflation went wild. Capital fled from paper assets into hard assets. Gold went from $35 an ounce to a peak of $850 by 1980. It was an astonishing flight from the dollar.
And that crisis led to the third major policy shift, 1979-82, the Volcker shock.
Right. The Fed chair, Paul Volcker, knew he had to restore credibility at any cost. So he did something that seemed insane at the time. He dramatically tightened the money supply and jacked up interest rates into the double digits, way higher than inflation.
A brutal medicine to cure the inflation disease.
It was brutal. It caused a deep recession, but it worked. It crushed the inflationary mindset and restored confidence in the dollar. But it also triggered a massive debt crisis for the rest of the world.
Because everyone else had borrowed in cheap dollars during the 70s.
Exactly. Emerging markets, European companies, they had borrowed billions in dollars, and suddenly they had to pay that debt back with these crushing interest rates. Many of them defaulted. It was basically economic warfare. Volcker's higher rates strengthened the dollar and protected American banks, effectively forcing austerity on the rest of the world.
That's an incredible display of reserve currency power. And after that, for decades, rates just steadily fell all the way to zero, which sets the stage for today.
Right. When the 2008 crisis hit, the central banks used their first tool, Monetary Policy 1, or MP1. They cut short-term rates, but they hit zero very quickly, so MP1 was exhausted.
But they moved on to the next tool in the box.
They pivoted to monetary policy 2, or MP2. We know it as quantitative easing, or QE. The central bank prints money and buys financial assets, like government bonds. The idea was to push down long-term rates.
And it stabilized the system, but it had that huge side effect.
A massive side effect. All that new money flowed straight into the stock market and real estate, making the rich, who own those assets, much richer. It dramatically widened the wealth gap and poured fuel on the fire of the internal political conflict we talked about.
So now, when MP1 and MP2 are basically tapped out, we have to move to the final historical play.
We get the inevitable pivot to monetary policy 3, or MP3. And this is fundamentally different. This is when the central government borrows trillions and the central bank just buys the debt, effectively printing the money for the government to spend directly.
Things like stimulus checks, bailouts, helicopter money.
Exactly. It bypasses the financial system and puts money directly into the hands of people and businesses. And this is a direct echo of what Roosevelt did in 1933. He broke the gold link and started massive monetized government spending. We are in the MP3 phase right now.
Which brings us to our final section, the current stress test. We're 75 years into this cycle. What are the biggest vulnerabilities right now, according to this template?
The assessment is pretty stark. First, internally, the high debt and zero rates mean the central banks are out of conventional weapons.
Yep.
They are committed to MP3, which is a highly inflationary path if you're not careful.
And what about the external vulnerability?
This is a huge one. The amount of dollar-denominated debt owed by non-Americans' emerging markets, European banks, Chinese companies, is around $20 trillion.
$20 trillion.
It's 50% higher than it was in 2008. So when the global economy slows down, all of these foreign entities are desperately scrambling for dollars to pay their bills.
Which creates this huge artificial demand for the dollar, propping it up.
For now, yes. If we connect this to the bigger picture, that structural demand for dollars is what's letting the U.S. keep its leverage, even as its own fundamentals weaken. The dollar is still used in about 55% of global transactions.
Which is way out of proportion to the U.S. share of the global economy.
Way out of proportion. The U.S. is about 20% of world GDP. That privilege lets the U.S. fund itself using MP3 right now. But every dollar it prints to solve its domestic problems risks undermining the long-term credibility of the dollar as a store of wealth.
So it's ticking clock. The world desperately needs dollars now, which keeps the system going. But the very actions the U.S. is taking to create those dollars are what will eventually destroy the system.
That is a classic end-of-cycle dilemma. The internal political need to print money is in direct conflict with the external need for a credible currency. The system is structurally pushing towards a new monetary order. The only question is whether it's a slow, managed decline or a sudden, chaotic collapse.
We've spent a lot of time on the mechanics of decline, which it can sound pretty bleak. But the study also emphasizes the positive side of that upward-pointing corkscrew, humanity's ability to adapt and improve.
That's the essential optimistic takeaway from history. These destructive periods, as painful as they are necessary. They clear out the rot, they force innovation, and they set the stage for a new and usually higher level of prosperity.
The people who lived through the 30s and 40s were called the greatest generation.
Exactly. Not because it was easy, but because the stress test forged an incredible strength of character and capability in them. Humanity gets smarter and stronger on the other side of these things.
So we should end this deep dive not with fear, but with preparation. We started by calculating the risk to the whole system. What's the final calculation you, the listener, need to make for yourself?
You need to calculate your own financial safety margin. It's a very personal question, but it applies to everyone. You need to ask yourself, honestly, how long would I be okay financially if the worst happened? If I lost my job and my financial assets were cut in half?
What's your real cushion against the cleansing storm? What do you own that's truly outside the reach of the printing press?
That's the calculation.
This has been an incredible deep dive. The confluence of debt, internal conflict, and the external challenge from China means we are squarely in one of these classic stress tests.
A restructuring of the world order seems inevitable.
The mechanisms are timeless.
So what does this all mean? We know the script. We know the cycles of debt and empire are universal. But the specific actions taken right now, especially with this massive monetization of debt through MP3 and how we handle these wealth gaps, that will determine what the next 75-year cycle looks like.
Whether it's a peaceful transition or a violent one, history tells us the odds, but it doesn't give us the answer.
It forces us to think about long-term resilience, not just short-term returns.
Exactly. And that leads us to our final provocative thought for you to take with you. History shows that when the money and credit system breaks down, there is a predictable flight out of currency and debt and into hard assets, gold, certain stocks, or assets in other countries that aren't having the same problems. So the question is, given the unique nature of our global unconstrained fiat system today, what assets, what foreign currencies, or what new alternative forms of money will prove to be the most resilient storehold of wealth in the next world order? Keep diving.